Most new investors do not lose money because they chose the wrong stock. They lose money because they did not understand risk before they invested. Returns get all the attention, but risk decides how long you survive. A beginner opens an app, puts money in, and watches prices move. When numbers turn red, panic appears. When numbers turn green, confidence turns into overconfidence. Decisions start reacting to screens instead of plans. This is the real problem. Investing rewards patience, structure, and control. It punishes emotional reactions and careless exposure. In this video, we are focusing on the mistakes that quietly destroy portfolios early on. The risk management errors that turn small setbacks into lasting losses. Once you recognize them, you can protect your money before trying to grow it. Let's start with the first and most common one. 1. Letting emotions control decisions. The market is designed to trigger emotion. Prices move fast. Headlines scream urgency. Social media amplifies fear and excitement. New investors walk into this environment unprepared. Fear and greed are not just feelings. They directly change behavior. Fear shows up during market drops. Prices fall. News turns negative. Losses appear on the screen. The brain goes into protection mode. Selling feels like relief. Many beginners panic sell near the bottom, not because the investment is broken, but because the emotional pressure feels unbearable. Greed shows up during rallies. Prices rise. Everyone seems to be making money. Stories of fast gains spread everywhere. New investors feel left behind. They rush in late, often at high prices, chasing what already happened. This emotional cycle repeats constantly. Buy high, sell low. Not because people are careless, but because emotions override logic under pressure. Good risk management starts with emotional control. Successful investors accept volatility before it happens. They expect markets to move up and down. They plan responses in advance, instead of reacting in the moment. They do not ask, "How do I feel today?" They ask, "Does this still fit my plan?" New investors often believe emotions disappear with experience. They do not. The difference is that disciplined investors do not act on every emotion. They create rules that protect them from themselves. If checking your portfolio changes your mood, risk is already mismanaged. Calm behavior comes from structure, not confidence. 2. Failing to diversify properly. Many beginners hear the word diversification, but they do not apply it correctly. Some put all their money into one stock they believe in strongly. Others focus on one sector. Tech only, crypto only, one country only. It feels focused. It feels confident. It is extremely risky. When all money depends on one idea, one event can damage everything. Earnings miss, regulation change, industry slowdown. A single shock can erase years of progress. Diversification is not about avoiding risk completely. It is about spreading risk, so no single failure destroys a portfolio. True diversification means holding different assets that behave differently. Stocks for growth, bonds for stability, real estate for income, cash for flexibility. It also means spreading across industries and regions. New investors often resist diversification because it feels slow. They want big wins. They want concentration. What they forget is that concentration also concentrates loss. Diversification protects against being wrong. And everyone is wrong sometimes. Even great companies go through bad periods. Even strong sectors cool down. Diversification allows time to work without forcing emotional decisions. Risk management is not about predicting which asset wins. It is about building a portfolio that survives uncertainty. 3. Try and time the market. Market timing sounds smart on the surface. Buy at the bottom. Sell at the top. Avoid crashes. Enter only when conditions feel perfect. This idea feels logical, clean, and controlled. It is also one of the most common ways new investors hurt themselves. In real markets, timing consistently is extremely difficult. Even professionals with teams, data, and experience struggle to do it well. Prices move based on news, expectations, and emotion, not neat schedules. By the time something feels safe, prices have often already moved. Many new investors freeze because they wait for clarity. Markets feel too high, or too risky, or too uncertain. So they delay action, telling themselves they will start after the next drop. While they wait, markets continue moving. Dividends compound. Businesses grow. Years quietly pass with money sitting on the sidelines. Others take the opposite path. They trade too often. They jump in and out based on headlines, predictions, or short-term charts. This creates constant stress. It increases fees and taxes. It also raises the risk of missing the market's strongest days, which historically drive a large share of long-term returns. Missing only a few of those days can dramatically reduce outcomes. For long-term investors, time in the market matters more than perfect timing. Consistent investing spreads risk across many moments instead of concentrating in one guess. It removes the pressure to predict short-term moves and replaces it with discipline. Even investors who start during market highs and keep investing steadily often outperform those who wait endlessly for crashes that may not arrive. This does not mean timing never matters. It means beginners should not let fear of timing prevent progress. Risk management improves when you stop trying to be perfect and start being consistent. 4. Ignoring personal risk tolerance and goals. One of the most overlooked mistakes is investing without understanding personal limits. Some new investors take too much risk. They chase aggressive returns without realizing how they will react during downturns. When markets fall, panic sets in. They sell at the worst time. Others take too little risk. They stay overly conservative. Their money feels safe, but it does not grow enough to meet long-term goals like retirement or education. Both extremes are dangerous. Risk tolerance is not about how much risk you want. It is about how much risk you can handle without abandoning your plan. The time horizon matters. Money needed in the short term should not depend on volatile assets. Money for long-term goals can accept more fluctuation. Goals matter. Investing without a clear purpose makes decision-making emotional. With clear goals, risk becomes easier to manage. Good risk management aligns investments with real-life needs. It balances growth and stability based on time and temperament. New investors often copy strategies from others without considering personal context. That creates stress. A good plan fits your situation, not someone else's results. 5. Chasing trends without understanding. Trends are loud for a reason. They create urgency and excitement, and they make investing feel simple. When everyone around you is talking about the same stock, sector, or digital asset, it feels safe to join in. That feeling is exactly what makes trend chasing risky. New investors often buy what is popular without understanding how the business makes money, what risks it faces, or what could cause growth to slow. Decisions get driven by headlines, social media posts, and short-term price charts. At that point, investing turns into speculation. You are reacting to movement instead of evaluating value. When the trend cools, uncertainty hits fast. Prices fall. News turns negative. Without a clear reason for owning the asset, confidence collapses. Many investors sell at the worst moment, locking in losses they never planned for. Research is not about predicting tomorrow's price. It is about knowing what you own, how it generates returns, and what conditions would change your decision. That understanding creates patience. It allows you to separate normal volatility from real problems. Investors who study their investments manage risk better because they are prepared. They know what would make them hold, add, or exit. Trend chasers have no plan when excitement fades. Chasing trends replaces thinking with copying. It feels easy, but it removes control. Risk management improves when decisions are built on understanding rather than popularity or noise. Now let's connect all 5 mistakes. Emotional decisions amplify losses. Lack of diversification concentrates damage. Market timing increases pressure. Ignoring personal limits creates panic. Chasing trends removes control. These mistakes are not about intelligence. They are about behavior. Good risk management does not eliminate risk. It controls it. It accepts uncertainty. It builds resilience. You do not need to fix everything at once. Start with awareness. Ask yourself simple questions. Do I understand my risk limits? Do I have a plan? Do I react emotionally? Am I diversified? Small adjustments can prevent big mistakes. Let's wrap this up. New investors lose money not because markets are unfair, but because risk is misunderstood. Protecting capital matters before growing it. Discipline beats prediction. Structure beats emotion. If this video helped you see risk more clearly, like it, share it with someone who is new to investing and struggling with decisions. Subscribe to the channel for more simple, practical guidance on building wealth the right way. Thanks for watching.